So the next thing we're going to touch on here is FEGLI. That is your Federal Employee Group Life Insurance. Now, parts A, B, and C of FEGLI are 5-year renewable group term life plans. So they are not permanent life insurance. It's important to keep that in mind. They do not have cash value. You cannot do loans against them. Um, and generally, the only way they're going to pay out is if you pass away, right? And they'll pay to your beneficiaries. Um, Essentially, FEGLI as a whole is not provided. It's not actually the federal government insuring you. It's MetLife. You may know them with the with Snoopy and the Peanuts gang. But MetLife has an exclusive contract with OPM to provide all of the federal life insurance under FEGLI. So types of FEGLI coverage. You have basic FEGLI coverage. Basic also has a sub entity called extra FEGLI coverage, which we're going to touch on all these individually in a second. But you have option A, option B, and option C. Option A is a flat $10,000. Option B is the coverage amount that you can, it's your salary, and you can do 1 to 5 times that salary. And then option C is the family coverage for you. Now, we're going to touch on the basic FEGLI coverage now. So there are 2 types, as I mentioned. They're all group life, term life plans, but there's no medical examination, so no health questions to get in. So it's pretty easy. And basic does give you some options to be continued into retirement. Uh, there is also AD&D coverage, accidental death and dismemberment coverage, if you're, which basically doubles the benefit in those very exclusive situations. So FEGLI Basic is an automatic benefit. You can opt out of it. Um, you have to do so in writing before the end of the first pay period, but you do have the ability to opt out of FEGLI coverage. I don't necessarily recommend that because FEGLI Basic is relatively cheap and decent. Different than A, B, and C. Those are different viewpoints on those, but again, no health questions on here, and the premiums that you pay are calculated according to your not to your health. It's really your income and how old you are. So basic FEGLI coverage, the way they calculate it is that they take your annual pay and they're going to round it up to the next $1,000 and then add $2,000 to it. Um, I know that sounds like a random calculation or formula, but you got to think when this was created, which was many, many years ago, $2,000 was a pretty substantial amount of money. So this was thought to be a nice boost to this plan. A little bit different today, but they've never made any changes to this way this coverage is set up. So let's say, for example, your salary uh, is $97,500. Well, they're going to round that up to 98,000. Then they're going to add 2,000 to it, which gets you to 100,000. That 100,000 is your basic coverage amount. Um, Extra basic coverage, if you're 35 years of age or under, at no additional cost, they give you this extra coverage, and it basically doubles what you have for basic. So you have an extra, you have the same amount that you'd have under basic. However, from age 35 to 45, that extra coverage declines by 10%. So now that's okay. You're not paying anything for it, but they're going to reduce it out at age 45. You don't have any extra coverage anymore. You just have the regular basic coverage, which was the salary rounded up to the nearest 1,000 plus 2,000. The reason they do this bonus money from 35 or bonus coverage, if you will, from basically uh, anything under age 45 is that they view that time frame from your early years of employment up to like 44 as being generally the childbearing years of employment, young child years. And so they want to make sure that your family has at least some protection in place should something happen to you. So this was their way of trying to help that. And again, there's no extra cost for it. Pretty good deal, but it does go away. So the way that you pay for the basic coverage is the employee pays 16 cents biweekly per $1,000 of coverage, regardless of your age. This particular unit, only basic, doesn't have age tied to it. It's just based off of your pay rate. And so it's 16 cents biweekly per $1,000 of coverage. That's it's about two-thirds of the total cost of the coverage. The government pays the other third. However, if you're a postal employee on here, your union negotiated out that there's no cost for the basic while you're an active employee. So that's a really good deal. Now, when you get to filling out your retirement paperwork, you're going to have three options when it comes to basic FEGLI coverage. The first option is keep it all. Second option is take a 50% reduction. And the third option you'll have is what they call 75% reduced. You may hear people talk about this being the free stuff. You get to keep the free stuff, right? And so 75% reduced means you're keeping 25%. What happens is essentially once you are retired, you pay 32 and a half cents per $1,000 of coverage every month until you get to age 65. And then from 65 on, you don't pay anything at all. Now, if you're, let's say, 65 when you retire, you won't pay anything, but the coverage is only it doesn't immediately drop to 25%. It reduces from the full amount 2% per month until it gets to that 25% remaining amount. And again, from 65 on, you're not paying anything. And before that, this 32 and a half cents is the same uh, calculation at 16 cents biweekly. It's just instead of having 26 pay periods, you're only having 12. So option two is the 50% reduction. If you choose this one, that means you're keeping half. You're going to pay $1 and 3.5 cents per $1,000 monthly until you get to age 65. And then at 65, it drops back to 71 cents per $1,000 monthly afterwards. And the reason, again, it's dropping is because you're getting a portion of it paid for by the federal government. Option three, you'll see here is no reduction. So you're keeping it all, right? You're going to pay $2.45 per $1,000 each month until you get to 65. And then from 65 on, it's going to drop to $2.13 per thousand from that point on. The premiums are taken from your pension check. So important to keep that in mind. I would say case by case on whether you take more than the 25%, whether you choose to elect more. Definitely something I would encourage you talking to us about, talking to a financial planner, but building it into your retirement plan. Some of you may need the additional life insurance coverage based on your goals and estate planning, strategy. Some of you may not. So definitely something to keep into consideration. So FEGLI, optional coverages. Optional coverages can only be elected during really life-changing events. So you can do it when you first get hired. You have about 60 days from the time you're hired or promoted to regular full-time service. You can opt into it. After that, the only times you're allowed to make changes to your FEGLI options is changes in marital status, so getting married or divorced, birth of a child, adoption of a child, or the death of one of those children or spouse. Those will create an open window for you to make changes to your FEGLI coverage, your optional FEGLI coverage, which is generally A, B, and C, which we're going to dive into here. Don't count on this, but every once in a blue moon, FEGLI does have what they call open season. So it's been, I believe, 8 or 9 years since the last one. Again, they're very rare, but when they do announce a FEGLI open season, you can also go in and make changes and not having one of those other qualifying events happen. But again, this is not to be confused with your regular annual health insurance open season. This is a FEGLI special cover or open season that again is very rare. They will make it known that it's going on, but don't count on it happening for your plan. So option A coverage, it's a flat $10,000. The employee does pay the full cost. It also includes an AD&D benefit, which is like that doubler, kind of like the basic coverage. This benefit automatically reduces by 2% per month from the time you turn age 65 until it reaches $2,500. This is if you've opted to keep the 25% of basic, then you get to keep the $2,500 of option A if you had elected it from the get-go. It is also at no cost for that $2,500. So it's a little bit of a booster, but it does cost you along the way, and it does work from a pricing standpoint different than basic does. So the way it works, if you're under 35, you pay 20 cents biweekly or the equivalent of 43 cents a month for the coverage. And again, that's $10,000. And then from there on, it's going to go up every 5 years. So at 35 to 39, you pay 30 cents biweekly or 65 cents a month. 40 to 44 or 87 cents a month. 45 to 49, you're up to $1.52. Then 238, 433, and then a big jump from 59 to 60, where it goes from 433 a month to $13 a month. There are no additional tiers after that, again, because it's going to reduce out at 65. But certainly able to be kept. Not everybody does, but something again that's kind of individual to you. Option B, this is 1 to 5 times your annual basic pay, rounded to the nearest thousand. It does not include the $2,000 kicker that basic has. This is just your salary rounded up. So employees pay the full cost on this. This also works in 5-year age brackets, just like Part A. And then at retirement, you have options. It is going to reduce at 65. It is going to reduce by 2% a month for 50 months until it's completely gone, unless you elect to keep it, in which case it's going to be a higher premium and it's going to be based on your age. And so let's walk through this one because this one can get a little scary over time. So under age 35, it's 2 cents biweekly per $1,000 of coverage you have, or 4.3 cents monthly. That is a great deal, very inexpensive. At 35, though, is when it starts to go into these 5-year age brackets. So you'll see it goes from 2 cents to 3 cents to 4 cents. Now on the monthly side, it's 4.3 to 6.5 to 8.7 cents. Now all of a sudden, there's a pretty big jump here. It goes from 8.7 to 15.2 cents per month. And then at 50, it's going to jump to 23.8 cents a month. So you can see this is not quite double, but it's a pretty big jump. And then from when you go from 54 to 55, this is a big jump. This is more than double, 23.8 to 43.3. This is where most employees start to recognize, if they have this coverage, that, oh, this is starting to get a little pricey on me. If you want to keep coverage beyond this point, and are healthy, I would encourage you to explore life insurance in the open market, because you can probably get it for less than what you're paying through FEGLI. But if you are not healthy, need to keep it, and certainly you can. But notice that it's going from 43.3 to 95.3 to $1.17, and this is per $1,000 of coverage, and it will keep going up. At age 80, you're at $5.72 per $1,000 of coverage. So this is very, very expensive life insurance later on in life. Option C, this is family coverage. So it's priced a little bit differently. They call them units. And so a unit will cover a spouse and all of your children that are under age 22. So the units, the way it works is each unit is $5,000 of coverage on a spouse and $2,500 in coverage on each child that you have that falls into that under 22 category. So note that it's a unit. So if you have a spouse and 5 kids, it's still just one unit. You're not paying for each of those family members. So in that aspect, it's actually a pretty good deal. Employee does pay the full cost, and you can select from 1 unit to 5 units. So you can technically get up to $25,000 of coverage on a spouse and up to $12,500 in coverage on each child. It does automatically decrease for 50 months until it turns, it zeroes out at retirement at age 65. However, you can keep it if you want. There are a couple of cautions in here. First of all, if you get to that point and the only thing you're covering is a spouse, you probably want to look at other options. There's definitely cheaper ways to do it for that level of coverage. But the other thing that you want to keep in mind here is if you are, let's say, covering children, and let's say you're single and but you have children that are on this plan, FEGLI is not going to notify you when your children age out. That is your responsibility to keep track of. And so when your kids fall off of this coverage amount, you need to notify them that you HR that you need to drop this FEGLI coverage because you don't have any eligible uh, children to be covered anymore. They will keep charging you if you do not do that, and you'll be paying for coverage that doesn't exist. So definitely make note of that. If you've got option C on your pay stub, um, which you may or may not be able to tell, some pay stubs will list out A, B, and C. Some of them list out a code, which I can help you decipher if you need to. But if you have option C and your children aren't under 22 anymore, you definitely want to take a look at this. The way they price it, under age 35 is 22 cents per unit biweekly or 48 cents a month per unit. So pretty good deal. It's very cheap. Does go up in 5-year increments. This doesn't really make sense because the coverage is on your spouse and kids, but they price it based on your age, the employee. So you can see here it's 48 cents a month under 35. Then it goes at 35, it goes to 59, then at 89, $1.28, $1.99. And it's going to keep on escalating up until you get to age 80, in which case it's $15.60 a month per unit of coverage. So this is talking about FEGLI beneficiary designations. Uh, the form to change your beneficiary or to update your beneficiaries is SF 2823. I'm going to use this as an opportunity to remind you all to check and update your beneficiaries on all of your plans because doing your FEGLI beneficiary designation does not change your employee pension designation, your employee pay designation, or your TSP beneficiary designation. They are all separate forms. Um, I encourage you to change these anytime you have a life event or update these anytime you have a major life event happen. If you haven't updated these in a long time or you don't know who your beneficiaries are, just do them again. It will replace whatever you have on file. But we've had countless examples of people that did this when they first got hired. They were maybe married at that time, later on got divorced, never remembered to go and change the benefit, or maybe they got married and originally they list their mom or their brother or somebody like that, never changed it. The death benefits don't end up going to where you want them to go. So it's important to take a look at that and update that so that what you want to have happen does actually happen.